Hi, welcome to today's video. Today's video will focus on Treasury stock transactions, and we'll first start off with looking at some facts with regards to Treasury stock. First fact is that they're recorded at cost. This cost is their par value. So if the par value of the stock had been $1 and we purchased it at $5, then the par value for Treasury stock is $5. Of course, it's not paid a dividend because it's a stock we own, so we don't pay a dividend to ourselves. So let's look at an example so that we can kind of see about Treasury stock. They purchased 1,000 shares at 12 on 1-1 one. The par value of the stock was $10. We sold 400 at 20 on 120, and we sold 100 at 8 on 2-1. A couple other notes that I just happened to remember as I was writing this is that Treasury stock is a contra equity account. Contra equity means it's negative equity or a subtraction from equity. So if our Treasury stock happened to be $1 million and common stock and retained earnings happen to be $100 million, then total equity would be $99 million, as that $1 million would subtract. It's generally also the last item in stockholders' equity, although there are some variations there. Let's look at the journal entry so we can see if we understand what's going on. So the first fact was we purchased 1,000 shares at $12 a share. The par value was $10. The par value has nothing to do with any journal entry. So on 1-1, Treasury stock we got that was worth $12 a share times 1,000, or $12,000. We paid $12,000 in cash. So that was $12 times 1,000 shares. On 120, we sold 400 shares at $20. So we got cash at 20 times 400, or 8,000. That's what we got. How we got it was we sold 400 shares of Treasury at the par value of Treasury, which is 12, or 4,800. The paid-in capital and excess from Treasury stock sales then would be the $20 that we sold it for minus the $12 that was the par value of Treasury times 400 shares, or 3,200. On 2-1 one, we sold 100 shares at 8. So we got cash of 100 times 8, or $800. The Treasury stock we do second. So that was 100 shares at a par value of 12, or $1,200. The paid-in capital in excess now is debited because we did not get an excess. The par value was 12. We sold it for 8. So 12 minus 8 is $4 short times 100 shares, or $400 as a debit to the paid-in capital and excess account. So notice if we get less than the par value of Treasury, we debit paid-in capital and excess until that runs out. If we get more, we credit paid-in capital and excess for that amount of extra. Again, Treasury stock is where we buy our own stock for many different reasons, and we record it at cost. Cost is the par value. No dividend is paid to Treasury stock. It is a contra equity account, which means it's negative to equity, so it's subtracted from total equity. And generally, for most preparers, it's the last item in stockholders' equity. So I look forward to seeing you on the next video. Take care.